Donald Trump's trade strategy was never just a policy, it was a financial ripple that the entire world felt. Whenever Trump targeted a sector, global supply chains tightened, commodity prices shifted, and currency markets reacted within seconds. And today, we're breaking down that ripple, the moves, the market shockwaves, and the global financial patterns that still echo in 2025. When the trade ripple started, Trump didn't enter trade negotiations quietly. He entered them like a force of economic gravity, pulling markets, investors, and industries into a new orbit. The moment new tariffs were introduced, something unusual happened. Analysts froze mid-report. Investors recalculated their strategies. Import-dependent economies started adjusting overnight. This wasn't a typical trade shift. This was a rewiring of global pricing power centered around the U.S. economy. The investor reaction chain. Every trade announcement triggered a predictable yet powerful chain reaction. Step 1. Gold spiked. Investors rushed toward gold as a safety asset, using it to hedge against trade uncertainty. Step 2. The U.S. dollar strengthened. Capital started flowing toward U.S. markets because investors believed American assets were better protected. Step 3. Asian markets wobbled. Countries with heavy export linkages, especially manufacturing hubs, saw sudden volatility. Step 4. European production costs shifted. The UK and Germany faced rising input prices, forcing factories to rethink profitability. Trump's decisions didn't just move markets. They reset how global investors interpreted risk. The supply chain shake-up of the biggest tremors came from supply chains. A single tariff meant delayed shipments, contract renegotiations, price recalculations. Manufacturing reroutes, factories in Europe, Asia, and even South America had to adapt fast because the U.S. was still their biggest customer. And when the biggest customer changes the rules, every supplier on the planet feels it. Commodity market whiplash. Trump's trade moves also spilled into commodity markets. Oil, steel, aluminum, agriculture, even rare earth metals all saw sharp fluctuations. Not because of shortages, but because financial models had to rewrite the future. Where will demand come from? Which countries get cheaper access? Which industries benefit? Which ones slow down? Commodity traders started calling the Trump trade era the pricing storm, because every curve they predicted got reshaped by a new trade headline. The dollar dominance effect, one of the most fascinating outcomes. The U.S. dollar became even stronger, not because the world was calm, but because investors believed American markets were still the safest place to park money during global uncertainty. As the dollar climbed, importers felt pressure. Exporters gained short-term advantage. Emerging markets saw volatility. Commodity prices reacted instantly. This wasn't a political effect, it was pure financial psychology driven by global risk sentiment. The market memory that stays in 2025. Even today, in 2025, analysts still study the Trump trade era because it revealed something important. One trade decision can move global markets faster than a central bank announcement. It showed how tightly the world is connected. It proved how quickly investors react to trade uncertainty. And it highlighted how one nation's economic strategy can shift global momentum. That's why economists still track those patterns. To predict the next big move in commodities, currencies, and global supply chains. Trump's trade decisions didn't just make headlines. They created a blueprint for how markets behave under aggressive negotiation. A blueprint that investors, analysts, and governments are still decoding today. If you want more deep-dive financial breakdowns like this one, make sure to subscribe because the global market never sleeps and neither do we.